covered in the commercial markets. You can have different triggering events. You can customize the insuring clause. You customize the exclusions. So you have a lot of wide latitude there. Somebody asked about Nevada. What states do we like? Nevada's a good state. Utah's a good state. Montana's a good state. You got Kentucky. You got Delaware. Florida just enacted a new legislation. I don't think they've funded their department yet. South Carolina's a great state. North Carolina just enacted new legislation. Delaware's a great state. New Jersey's a great state. There's a whole bunch of states. Generally, it's not required that the captive be formed in the state where the insureds are at. So you have some wide latitude. Hawaii's a great state. I don't want to miss any states. I'll get somebody mad at me, one of the regulators mad at me, but I think I covered most of them. Tennessee's a great state too. Somebody's reminding me that. So Tennessee's a great state. They're very, very good and very active and very. One of the things on the domicile is business friendly. Tennessee's very business friendly. California doesn't have any enabling legislation. Texas, of course, Vermont. Somebody just put Vermont. Vermont's the granddaddy of them all. Alabama has legislation, and Texas has new legislation. So there's several states that have legislation. Now, there are a few states, though, that are really active and have funding the departments, and more importantly, as their load increases, they're increasing their funding for the departments, which can be a problem because some states, they'll start doing captives, they'll bring in revenue, and then the legislature and the governor of that particular state won't give them more money, which creates problems for those states. So when you're picking a state, you got to be cognizant of that. I know, for example, Utah keeps increasing their funding for their state. Same thing with Montana, and several other states, the same thing. So now, let's answer another question that just came up. Let's say you do the captive, put the money into the C Corp for premiums. Let's say it generates a lot of underwriting profit over time. How do you get the money out? Well, it's either a capital gain when you shut down the C corporation, or if you take a dividend, it's a qualified dividend. That, of course, has some good income tax effects because when the money's coming out, it's coming out at a lower rate than when it went in. And, of course, if it's owned by a trust for the benefit of your children, that money's also outside your estate. Now, anytime you take a dividend, you have to get approval from the regulators. They need to be shown that there's enough money in there to cover the policies that are still outstanding. So those are particular issues I didn't cover before. So this happens from time to time. I had captives. Clients have a captive, and they have their businesses. They go along for a while. Then they sell their business. They need to shut down the captive. You can get regulatory approval for that. Usually you can cut the policies off right before the close of the sale of the business, or sometimes keep some of the policies going. Depends on what the client wants to achieve and what they work out with the buyer. Or maybe keep the captive going to cover some of the reps and warranties insurance, which is commercially available, but the client might choose to cover it in their captive themselves. Which book? All right. Is there one more polling question? Scott?
There is, Fred. Yeah, we have one more, and we can go ahead and launch that one now. I'll put it up on the screen.